Hey, good morning to all of you. Welcome to our class. Okay, at the end of last class, okay, I told you that shall be discussing only the core accounts. And last week we did complete on how we do audit the non-current assets. Okay, today we shall discuss how we audit inventory. Okay, so today is more towards the audit of inventory, audit of the company inventory. Okay, that's what I want us to discuss today. Inventory. And the same steps that we were discussing under the case of audit of non-current assets. Okay, so we follow the same step. Okay, first is to know what are the financial statement assertion. Okay, that shall be applying on that particular account. Okay, the next is to now for each of the assertion, okay, for each of the financial statement assertion that applies on that particular account, okay, what procedure can you use now? Can we now use what substantive audit procedures can we now use to assess whether that particular assertion put forth by the management, okay, present a truth and fair view, okay? So this is the procedure that we process that we discussed. Okay, so first get to know what are the financial statement assertion, okay, on that particular account. Okay, next is to determine the procedure you can use to test each of those assertions, okay, that you have put forth. Okay, that is simply how we're going to be doing in the case of the inventory. Okay. As you mentioned, okay, so we shall be, okay, since the process might be a bit repetitive, okay, comparing with the case we discussed with the non-current asset, okay, so I'll pay more concentration towards the unique, okay, procedure that shall be applied on that particular account, okay, so only on the unique procedure, okay, in maybe case of inventory, one of the unique procedure is the inventory count as well as on that particular information, okay, those will be a unique procedure, okay. So this is going to be, okay, our unique procedure here is on the inventory count procedure, okay, that is the actual counting of the inventory of the company, okay, either manually or whatever format the auditor need for, okay. Then the other procedure, okay, is getting more towards on valuation, okay, how do you value inventory, okay, as per the requirement of IS2, okay, what does IS2 recommend us to do when it comes to inventory valuation, okay. Then if the sum of the company inventory are being held by a third party, in short, the company has inventory, however, the inventory are not in the company warehouse, okay, the inventory might be with maybe a supplier, okay, who is yet to deliver, okay, so how do we account for them, okay, how do we ensure that the company has done the correct accounting, okay, for inventory held by that party, okay. And also the monitor, okay, what referred to as the attendance of the inventory count, okay. How do you attend the inventory count, okay? In case, for example, you may not be available, okay, to actually attend the inventory count, okay. What do you do in that case, therefore? Okay, do we rely on the report by the internal auditor? Okay, because actually that is one of the things that we can do. Okay, trying to ask the internal auditor. Okay, you are the one who did attend the inventory count. Okay, so get to know from the internal auditor perspective. Okay, what they think with regard to how the inventory count was done, for example. Okay. So that's what shall be how our main concentration on, okay, the unique procedure, okay, that do apply in the case of the non-current assets, okay. Okay, so a reminder of where we are, okay, don't forget we're still discussing on the substantive audit procedure for the unique accounts, okay, unique in quotes, okay, but essentially the major component of the company accounts, okay. Now, what assertions therefore apply in the case of the inventory? Okay, what assertion is what assertion apply in the case of the inventory? Okay. Now, the financial statement assertion. Don't forget this is an asset account. Okay, so they're going to be more or less like what you had in the case of the non-current assets. Okay, they may be more or less the same. Okay, existence and occurrence. Okay, on the case of the existence is do the inventory the company seem to be reporting on the balance sheet actually, do they exist? Are they there? Okay, or is it just a hoax? Okay, so do they actually exist? Okay, can we go, if they're physical inventory, okay, can we go to see them? Can we count them? Can we go to carry out a physical inspection of those inventory? Okay, that's on the existence. Okay, if the company more or less towards the case of the P&L, okay, towards the side of the profit and loss account, okay, if the company made a sale of the inventory, okay, it was there an actual sale that did occur, okay. If the company said that we did make purchase of the inventory, was there an actual purchase that did occur? Okay, the occurrence is going to be an assertion that shall be applying in the case of the profit and loss account. Okay. Now, towards the completeness, okay, towards the case of the completeness, okay, simply we're trying to assess as to whether the company or it's more towards the recording, okay, it's more towards the recording, okay, how the company purchases and maybe sale, okay, that did occur during the year, have they been recorded, okay, is the company inventory accounts or records, okay, complete in the sense that we have been able to document, okay, any single movement, okay, in and out of the warehouse, okay, in quote, okay, can we be able to document, okay, or has the company be able to document, okay, every single movement that did occur in the inventory, okay. The in means that the company made a purchase, the out means the company has actually made a sale, okay. Has the company been able to record every single movement, every single transaction that did occur, okay. And of course, at the end of the day, on the balance sheet side of it, okay, is that if, for example, the company says that at the end of the year, we have 1,000 inventory of this X unit, okay, is that that particular value at the end of the year, okay, do represent, okay, it has been accounted for, okay, by all the in and the outs, okay, by all the movement that occurred during the year, the purchases as well as the sales. And even not just the purchase and sale, okay, maybe there's some inventory, okay, that were declared maybe redundant, okay, maybe the inventory were obsolete, okay, they were, what's the best term to use, okay, they were still, they had expired, okay, then that still is a movement, okay. So the movement is not just the case of the purchase and sales, okay. The movement also includes, okay, if there was some inventory that maybe were destroyed along the way, okay, also that need to be recorded, okay. So all the movements, okay, be it be purchase, be it be sales, okay, be it be some inventory that were wrongly recorded, okay, be it some inventory that were has expired, some inventory that have been obsolete. So all these need to be properly recorded in the company records, okay. Of course, towards the rights and obligation, okay, don't forget still this is an current asset. This is an asset account, okay. So the rights of the that imply therefore the company has the right to the receipt of any future economic benefit, okay, that accrues on that particular asset. It means therefore the company has the right to receipt of any cash from the disposal, from the sale of the particular inventory, okay. Towards accuracy, no, actually towards the rights and obligation, okay, towards the rights and the obligation, okay, we shall mention later on, okay. Let me just take it back, okay, on a slide here, on what called the third party confirmation, okay. Thus here is where you have to be careful with the rights and the obligation, okay. If, for example, some inventory, okay, has been held by third parties, okay, either the company has made a purchase, okay, and the company is yet to receive them, okay. That means, therefore, those inventory belong to the company. In that context, therefore, it means, therefore, as an auditor, you need to ensure that the client has reported, okay, those inventory, even though they are not on your client warehouse, okay, they need to appear on the balance sheet because they belong to the client, okay. It's only that they have not been received so far, okay. So those inventory need to appear on the balance sheet, okay. At the same time, if the company is holding inventory on behalf of a third party, okay, if, for example, the company has made a sale, okay, to a client, okay, to a customer, and the customer is here to come and collect those inventory units, okay, the sale units you have just made, okay. Don't forget the company should not include them in the balance sheet, okay, because they have already received the economic benefit. Okay, so they should not be reporting, okay, those inventory on the face of the balance sheet, okay. Towards accuracy, classification, and evaluation, okay, towards the accuracy, classification, and evaluation, accuracy, of course, is that the figures you're going to be reporting, okay, these as they are. In case about the sale, okay, if you make a sale worth 10,000, you're going to coordinate as 10,000, okay, not 15,000, okay. If it's about the purchase side, okay, the cost we incur, okay, we are not going to be artificially inflating the price that we bought the inventory at, okay, so the accuracy. Towards classification, of course, is about trying to ensure that we do classify the inventory in their correct classes. Okay, if, for example, the company is involved in manufacturing, they'll be having the raw material, they'll be having the work in progress, they'll be having the finished good. Okay, that's more applies therefore to the classification side of it. Okay, valuation, of course, as you shall mention, as per the requirement of IS2. Okay, what does it say regarding how we ought to value inventory? Okay, okay, what does IS2 say by the way regarding how we value inventory? Just check as to whether your accounting is still on. Emma. Emma.
Yes.
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 What does IS2 say regarding inventory valuation? Before I say.
It says that inventory should be measured at the law of cost and net realizable value.
Okay, thank you, Emma. Okay, I've just seen it. It is here on the note here, but thank you, Emma, for that. Okay, that we value inventory at the law of cost and NRV. Now, what does NRV mean? Let me get someone else to check on. What does the NRV mean? Jeffrey.
Yes.
What does the net realizable value mean?
The amount you can generate from a sale less the depreciation.
Less depreciation, okay?
Yeah.
Don't forget, depreciation applies to the non-current asset, okay? So it should be less what? I agree with the first bit of it, okay?
Less the amount involved in the inventory, in acquiring.
In acquiring, in making the sale, okay? In making the sale, okay? Don't forget, NRV is how much money you're going to be receiving. If you are to dispose of this particular inventory, okay? How much money will be receiving from a disposal? You shall be seeing maybe 1,000, okay? But how much cost do you incur towards this? How much cost have you incurred towards making that sale, okay? The selling cost, more or less, okay? So it's going to be the amount you shall be seeing from the disposal less the selling cost. That we mean by the NRV, okay? Therefore, as an auditor, okay, what's your work? Okay, is to ensure your client is going to do like that, okay? That is going to be valuing the inventory at the law of cost and the NRV. Cutoff more or less implies therefore that you're going to be recording the transaction as and when they occur at their correct accounting period, okay? At the correct accounting period. If the sale occurred in the month of January, record it in the month of January, not in the month of December, okay? If the purchase occurred in the month of December, do not record it as it occurred in the month of January, okay? Accounting for purchase and sales in their correct accounting period, okay? And of course, towards the notes, the financial statement, okay? The more or less apply the same classification. They need to be quite understandable for the users, okay? Completeness, accuracy, and evaluation, okay? I think that's those will be the financial statement session that we shall be discussing along the way. Okay. Hope it's all clear. Okay. Now, as for the requirement of IS2, I think you just mentioned, okay, that when it comes to the valuation of the inventory, okay, when it comes to inventory valuation, okay, we are saying that we do value the inventory at the lower of cost and the net realizable value, okay, the lower of cost and the NRV. What is cost? It simply had the amount you did pay, okay, to acquire that particular inventory. Okay, how much do you pay? Okay, if there was some transport inward, then of course we need to record the transport inward cost. Okay, so all the cost you incurred towards or to have that inventory in your warehouse, okay, to have that inventory, okay, at the disposal of your client, okay, the cost you incurred, the VAT in case you need to pay for the VAT, the import duty in case you paid for import duty, okay, the transport cost, okay, the actual purchase, all those costs, okay, once we combine them, okay, to have the inventory at the disposal of the client, okay, that's what we mean by the cost, okay. NRV, I think I just mentioned, is an estimate. Okay, we are just estimating. Okay, how much money, how much can we fetch? Okay, from the disposal of this particular inventory. Okay, how much can you fetch from the disposal of this particular inventory? Okay, less the cost being carried to make that disposal. Okay, in case you're the one who's going to be transporting the good to the client premises. Okay, so then of course we need to subtract the transport outward cost. Okay. If you're the one who is going to be paying maybe for the tax of the client, just assume that can happen. Okay, then of course we need to less the tax to be paid if that's going to be the case. Okay, so NRV simply is the amount shall be received or what is going to remain in your pocket after you make the sale to the client. After taking care of all the costs incurred, you did incur along the way. Okay, we call the NRV, the net realizable value. Okay. So we're going to be valued based on IS2. And as I mentioned, okay, the only way you can do a good audit, okay, is in case you do know the requirements of the accounting standards, okay? Because don't forget, you are the advisor, you're the one who advisor in court, okay? And you're the one who is meant to critique the client, okay, on how they are preparing the financial statement. Okay? So you have to know the accounting standards for sure. Okay. This time actually your examiner had asked you to distinguish between these two terms. Okay, I think you're going to take the question back, but I think it's another question beyond your question back, but shall check it out. Okay, the time examiner was asking you to distinguish between the two. Okay, as per the requirement of IS2, what does cost and what does NRV imply? Okay, we shall take it. Okay. The first assertion, okay, the first assertion that applies on the inventory, okay, as I mentioned, is called completeness. Okay, completeness. Simply that every single purchase that occurred during the year have been recorded. Every single sale that did occur during the year have been recorded. Okay, so as purchase and sales, they have all been recorded. All the movement in and out of the inventory account, okay? All the movement in and out of the inventory account have also been recorded, okay? Okay, so that's is what you have to take note of, okay? Is the transaction that occurred in the year, have they all been recorded completely? Have the sale been recorded? Have the purchase been recorded? Okay, we need to ensure that that's happening, okay? So what do you do as an auditor? One of the way you can carry out, or one of the procedure you can carry out, okay, complete the disclosure checklist to ensure that all the disclosure relevant to inventory have been made. Okay, so if, for example, okay, in most cases, the client, okay, may need to be having what we call a checklist, okay, and the checklist can include a number of things. Okay, one of them is, for example, if there have been a slow-moving stock that the client may have identified. Okay, how do the client identify? Okay, slow-moving stock. Okay, how the client identify slow-moving stock? Okay, if that the case, then it needs to appear, okay, as one of the items within the inventory checklist. Okay, how the how the client was able to identify slow-moving stock. Okay. You can also trace test counts, okay, to detailed inventory listing. Okay, as we mentioned, one of the key unique procedure that we shall be using is the test count. Okay, test count. Test count simply means, therefore, you don't have to be involved as an auditor, okay, in counting every single transaction. That is going to be the work of the internal audit department of the client. Okay, the internal auditor is one who is going to be more or less going to be involved in that. Okay, them is their main duty, okay, of reviewing, okay, how the inventory count is being carried out. Now, you as the external auditor, what do? Okay, your work is more towards doing a called test count. If, for example, a client has said that we have audited, okay, let me just, okay, have my board here, okay. Okay, so if, for example, we have this case here, assume this is the floor of the client, okay, warehouse of the client, okay. So the client has the floor in 4 parts, okay. We have part 1, 2, 3, and 4 parts, okay. And the client has done the count in each of those 4 parts within his warehouse, okay. So as an auditor, you don't need to audit, okay, every single part of that warehouse. Okay, you can decide, I'll take maybe part 2, okay. As part two, what was as per the client report, okay, what was the inventory, okay, what was the inventory count, okay? They found, for example, 10,000 units of Y, okay? Now this is what this the report they did obtain, okay? Now you can ask them, provide me with this report, okay, that you did, okay? Now as an auditor, you're going to have this report that the client has prepared maybe through, of course, the internal audit department, okay? However, you can also do your own independent count on the same area, okay? So you can carry out your own independent count, okay? You can carry out your own independent count on that particular area, okay? You compare your results, okay, versus you compare your results, okay, X versus the result the client found in that particular area, okay? If, for example, the client found 1,000 and you find 1,100, then of course you need to ask the client why there is a material difference between the results you did count and of course what they did obtain. Okay, you can see that the point. Okay, doing a test count. You don't need to audit every single part of the warehouse. Okay, you don't need to audit every single part of the warehouse. Only do what called a test count. Okay. So in this case, the test count only applies in this particular area, not in 1, 3, and 4. Okay, that's a test count. Okay, I hope that's clear to all of you. So in this point, okay, trace test count result to the detailed inventory listing. Ensure therefore the results you obtain from your account, okay, they need to maybe if, let me just go back to emphasize on that point. If, for example, okay, assume the results here, if they don't tally, okay, between what you found and what the client found, okay, of course you need to make a reconciliation, okay, there need to be a reconciliation, okay, between your results, okay, versus the result the client found, okay, there will be a reconciliation. If, for example, there's no need for reconciliation because the results do tally, okay, in that case, therefore, you may want to go ahead and try to trace the result you found here, this inventory you just obtained here, okay, to the company inventory, okay, listing or documentation, okay. If the company, for example, has an inventory system, okay, then of course the result of this item you just found here on your test count, they need to appear on the inventory listing. Okay, if they don't appear, then of course you may want to ask the client whether they are holding, for example, inventory on behalf of someone else, for example, okay, because the results you just found, okay, of course those items need to be part of the client's inventory. If the client is not accounting for them, okay, in their books, then why are they there? Okay, so you need to ask the client or you need to trace the result you just counted back to the inventory, the client inventory system, okay, or the client inventory listing. Okay, I hope that that is clear. Where inventory is held in that particular location, physical inspection, okay, there is inventory or review confirmation received from that party and match the GL, okay. You have said that if, for example, the client, okay, some of the items the client is holding, or some of the inventory, okay, that are being held by a third party, okay, as I mentioned, just require what we by a third party. So here we do have this case, okay, so see that we have here this case here. There's a client, okay, so client A, and this is the supplier, okay, there's a supplier of the client, supplier B, okay. So the client has bought some item from supplier B, okay, so client has bought some item, okay, from supplier B. However, those items are yet to be received. Those items are yet to be received. So that means that those items are within the supplier's warehouse. Okay, these are the items. Okay, don't forget, as I mentioned, at the end of the year, of course, as a client, they need to account for these items. Okay, these items that are also in the supplier. Okay, they are with the supplier. Okay, they need to appear on the books of the company A, okay, on your client. Okay. Now, as an auditor, okay, how do you confirm whether it is true? Okay, the item the client has reported in their book, okay, they are actually items of the client, or it's just a hoax. Okay, now how do we therefore ensure that there is correct accounting for those items held by that party, the inventory held by that party? Okay. Don't forget, one of the way, okay, if it is possible, okay, it might be impossible, but if it is possible, okay, you should visit the supplier site, okay. You as an auditor, you come to supplier, okay. ask, I would want to confirm, okay, the inventory that my client here, okay, you're holding or you have some items that do belong to my client, okay. I want to confirm whether that is the case, okay. So you can simply be able to visit supplier, or even sometime, okay, if that's not be possible, okay, you can maybe ask supplier, okay, to make a confirmation, okay, whether through a letter, through a phone call, okay. Okay, you can also be able to do that, okay, by or in whatever way you can communicate, okay, between yourself as the auditor of client A and you contact supplier of your client. In this case, supplier B. Okay, that's this can be. That's simply identified as the third party confirmation. Don't forget, the supplier in this case is a third party. Okay, supplier in this case is a third party. So you're confirming from them, okay? Is it true there are some items you're holding on behalf of my client? Okay. Okay, so that's what we made that particular point. Compare the gross profit to the previous year profit or illustrate. Now, this is, don't forget, as I mentioned, the use of comparison, okay? The use of comparison, it's simply telling us that we need to assess what we call the substantive analytical procedure, the use of comparison, okay? We are trying to simply compare what has been the gross profit margin, okay, the gross profit margin for this year with the previous year. Essentially, there ought not to be too material difference, okay, between the profit we are making for this year versus the profit that we made for last year. If there are material differences, okay, between the gross profit margin, then we need to ask the client as to why that is the case. Is it mean that they are becoming worse off with time? Okay, could they be maybe is the company profit becoming worse off? Okay, if it is increasing, okay, it is known that it's not something bad. Okay? It could mean that the client is doing something good. Okay, that's why the profit margins are increasing. Okay, but need to be supported. Okay, any material differences, okay, it need to be supported. Okay, if the company is becoming worse off, why is it that the case? Okay, maybe the industry becoming too competitive. Okay, they need to be some that support that particular figure. If not, then there could be there are misstatements that you may want to understand quite well as an auditor. Okay, so comparing the gross profit margins, okay, of this year and the previous year, for example, or this year, okay, versus the industry. Okay. Okay, as I mentioned, okay, the use of comparison, I think you already mentioned this. This is what this use of the substantive analytical procedures. Okay, that's on completeness. Okay, don't forget these are just examples of procedures that you can carry out. Just examples. Okay. Now towards existence. Okay, Karen, you have a question. Karen, yes, Karen. Karen,
Okay, I'm asking.
Yes.
You've said you can compare the gross profit of the previous year and the current year.
Yes.
And it should be the same.
Not necessarily. It can be different. Okay, that maybe last year the profit margin was, let's say, 20%. This year 40%. Okay, but however, if it is going to be material, that is, from, for example, 20 and 40. Last year it was 20. This year it's 40%. Then it need to be supported. Okay, why is the company growth profit increasing that huge, to such a large extent? Maybe the company has acquired another company. Maybe the company has been able to get a good supplier. It needs to be supported. If it cannot be supported, then there could be a misstatement occurring. There could be even fraud, maybe. Okay. And continue as a question. Karen, you've gone away.
You muted me.
Oh, okay. So back.
Okay, so is it a must you clarify where your profit has increased or has decreased?
So is it a must too?
you justify the increment or the decrement.
Yes, if it is material, then it need to be quite clear to you as an auditor, okay, why there is that a huge increment or decrement in the company gross profit. Yes, you need to do that for sure. Yes, that one is a must.
But we are only dealing with the profit, with the inventory.
Don't forget, okay, why is it increasing? I agree it's only on inventory. Don't forget the account here, okay, has multiple impact. The inventory account has multiple impact. What I mean by is pervasive. If the inventory balance is misstated, what other account might be affected? The profit of the company shall be affected. Always should remember, let me just remind you, okay, on how you do prepare the P&L, okay? Okay, don't forget in the P&L, in the classic P&L, okay, you can have here sales, okay, you're going to have opening stock, opening inventory. So you're going to have it here. Let me just, you're going to have here opening inventory. You're going to have purchases. You're going to have closing inventory. And that gives us therefore the cost of sale. Okay, that's gives us the cost of sales. And this is going to give us therefore the sales minus cost of sale give us the gross profit. Don't forget the sale in itself is out of inventory. This is inventory, purchase is inventory, close inventory, this is also inventory. So all these, okay, there is the impact of the inventory, the impact on how the company is carrying the accounting for its inventory has an impact on the company's gross profit. It has an impact on the company gross profit. And that's why I said you can use a gross profit as an assessment basis to assess whether there could be misstatement occurring on the inventory account. Okay, towards the sales, towards the purchases, of course, also towards the opening and closing inventory. Okay, I hope that's clear, Karen. Just to confirm whether that's clear.
Yeah.
Okay, so fair enough. Don't forget the inventory in itself, the movement, the purchases you made, the sales you're making. Okay, all of them have an impact on the company's profit. Okay, so as a matter, you can use the gross profit margin, okay, as a base of comparison. Okay, to have a hint. Okay, could there be misstatement? It does not mean there is misstatement. Okay, but could there be misstatements? Okay. Okay, now towards existence, one of the unique procedures we can carry out is called the use of the inventory count. Okay, the company is reporting that they do have maybe X units of this particular stock. Do they exist? Now, one of the procedures you can carry out on existence is on the inventory count, okay, which I think we shall discuss alone in a few minutes time. Okay, the inventory count. Okay. The next assertion, okay, that you can carry out is on rights and obligations. Okay, rights and obligation. Okay. Now, what does rights and obligation means? We have said that the company, this is an asset account. Okay, which implies therefore the company ought to be having the right to the receipt of any future economic benefits that that particular asset is going to bring forth. Okay, this is an inventory. In future, the company can make a sale of that inventory. Okay, so the cash to be received from the disposal, from the sale of that inventory is what we mean by the future economic benefit, the potential amount to be received from the sale of that inventory. Okay. Now, as an auditor, you want to assess, does this company has the right to the receipt of that cash in future, okay, from the sale of that particular inventory? Okay, that's what you want to verify. Okay. Now, what do you as an auditor therefore? Okay. Well, the procedure you can do is verify that any inventory held for that party is not included in the year-end inventory figure. Okay. We've just said that if the client is having some inventory, they made a sale. Okay. Let me just go back to my board to illustrate that point. If, for example, you have here a client, okay, there's your client A. So here they have a customer. So the company made a sale, okay, so they made a sale to customer B, okay, so there's a sale. Okay, that means therefore in the books of client A, they have recorded it as a sale. So this already appears as a sale. Okay, so this appears as a sale in the client A, your client therefore. Okay. However, client B is here to come and pick those inventory. So if the inventory still with your client, your client should not include them. When it comes to the analysis of the inventory closing balance, okay, the inventory closing balance, okay, those inventory the client has made sale on, okay, they should not be appearing in the closing balance figures. Okay, otherwise your client is going to be misstating the accounts. Okay, so they've already done the sales recording. Therefore, that particular they should not appear, okay, in the client's closing balance. Okay, but if the sales contract, okay, if the terms and condition of the sales agreement, okay, are yet to be fulfilled by the customer, okay, if the terms and condition under the sales agreement are yet to be fulfilled by the customer B, then the company should not record the sale, okay. In that case, the company should not record the sale. They should continue recognizing the inventory in their balance sheet, okay. Assuming if, I think you've done the law of sales. Have you? I think, just to check, I think you've done that. Quinta,
Yes.
you've done the law of sales.
Yeah.
I guess we may have done it somewhere along the way. The law of sales. I think you may have done it along the way. So as for the law of sale, okay, don't forget the client, you need to, okay, your client need to, or the customer as well as the client, they need to fulfill the terms and conditions of the terms and conditions as per the sale agreement. Okay. If one of the material item in the contract is not yet fulfilled, okay, for example, paying for it, paying for the goods, then the client can continue recognizing that the units as part of the closing inventory. However, they should not be reported. They should not therefore report a sale in that particular case. Okay. Okay, so verify that the inventory held for third parties is not included in the end-year figure. Okay. By observing whether the client has done the appropriate segregation during the inventory count. Okay, so those inventory that do belong to a third party, the client should not include them when doing his count. Okay, they should not be included when doing the count. Okay, they should be more or less in a separate room. Okay. Let me just go back to what we were discussing previously. This is what we're mentioning. Okay, we say that if the client has this is a warehouse, there's a client warehouse. Okay, the example that we gave before. Okay, we say that as long as you do the test count in part 2. Okay, the client, if the client is having some other inventory, okay, where they have made a sale, okay, and they're yet, for example, okay, deliver, okay, then they should have a separate warehouse, okay, separate warehouse for those inventory, okay, then because this is third party, okay, they should have a separate warehouse for that particular inventory held by that party, okay, and when doing the test count, they should not include this inventory, okay, they should not include this inventory, they need to be separate, okay. When doing the count, they need to be segregated. Okay, they need to be in a different location altogether when doing the test count. Okay, that's what we mean by that particular point. Okay, for any bill and hold inventory, that is inventory that has been sold but is yet to be, but it's being held on by the entry until the customer acquires it. Okay. Identify those inventory and ensure that it's segregated during inventory count so that it is not included in the area figure. I think I just mentioned that. Okay, where the client, where the company, okay, has actually made the sale. The client has actually made the sale. Okay, however, the customer is here to pick them up. Okay, or call the bill and hold inventory. The bill and hold inventory. Okay, and they should also not be included in the company closing balances. Now, the company has made a sale, therefore they have already done the recognition of sale, okay, of the revenue, okay. However, they ought not to include it in their closing inventory balances, okay. Then confirm that any inventory held by that party is included in the analysis. Now, if the company, okay, have received some or the company has made a purchase from a third party. Okay, the company has made a purchase from a third party. Okay, and this third party, okay, has more or less not yet delivered. Is now like the reverse of the bill and hold inventory. Okay, we have made a purchase. However, the supplier is yet to deliver them to us. Okay, don't forget, as a company, you ought to include them in the analysis. Okay, I think we did mention that in our board here, if I remember. Yes, it is here. Okay. The here is that if the company they bought some items from this supplier, okay, don't forget the company is going to recognize it, those items in its books. Okay, they need to appear in the books of your client. Okay, and of course they need to be recorded as part of the company purchases for the year. Okay, in that case, therefore, as an auditor, since the items are not in a company warehouse, so therefore you can't count them. Okay, we will say therefore one of the way you can go to the supplier, okay, warehouse, get to know where are these inventory. My client is saying that you are holding on their behalf. Okay, or you can ask a confirmation. Okay, draft a letter. Okay, ask supplier to confirm as to whether there's any inventory they are holding on behalf of your client. Okay. Then review any loan agreements, okay? Review any loan agreements and board meetings for evidence that inventory has been pledged or signed. If, or there could be instance, okay? There could be instance where the client do use inventory as a security. The client is using the inventory as a security to secure a loan. Cannot occur, by the way. Just to confirm. Samuel. Can that occur, okay, where the client use inventory as a security against a loan? It can occur. Okay. Now, if the client uses inventory as a security, what do you call it? What do you call that charge?
I think this is a floating charge.
It's a floating charge. Yes, thank you, Samuel. Okay, don't forget there's a floating charge. Okay, or that's referred to as a floating charge. Okay, so as an auditor, you may want to know, you may want to understand as to whether your client has any of the inventory that is being used as a floating charge. Okay, is being used as a floating charge. Okay. In that context, therefore, okay, in that context, therefore, as an auditor, okay, you may want to, as a client, okay, maybe through the management, through, okay, you do an inquiry, okay, get a client to help you understand, okay, is there any of the inventory, okay, that the client is using, okay, as a floating charge, okay, or even maybe you can ask the, maybe you can review, okay, the board meetings, okay, to assess as whether the management, okay, that is those charge governance have actually has actually used that inventory as a floating charge. Okay, so review loan agreement and the board meeting minutes, okay, for evidence that the inventory has been or is being used as a floating charge. Okay. I hope that's all is clear. Okay. Then you can also inquire of the management about any warranty obligations. Okay. Now to us, no, actually, just before we go to the next point, okay. Now towards a floating charge, okay, towards a floating charge, okay, you may want to assess to review, okay, those loan agreement, okay, and assess as to whether the company, those loan agreement and assess as to whether the company is in. There's no any term and condition of that loan agreement, okay, that the company has not fulfilled, okay. So as the management, okay, may go through the loan agreement, okay, try to see what were the terms and condition of the loan, okay. Has the company not fulfilled either of those terms, okay? Has the company not fulfilled either of those terms? Because if the company has negated the term, one of the material, okay, term and condition of the loan agreement, what will happen to the floating charge? Kami.
Yeah.
So if the client, okay, did use the inventory as a floating charge, okay, and one of the term of the loan is, for example, they're meant to pay maybe interest every month. However, now is 3 months down the line, the company is yet to pay the interest. What happened to the floating charge?
I'm not sure.
Okay, let me check someone else. Okay. Jeffrey. Jeffrey?
Yes.
Yes, what will happen?
The asset will be sold.
The asset will sold. Yeah, more or less. Okay, that can happen. But what is what normally happens? Okay, I think what normally happens is that the floating charge becomes a fixed charge. Okay, it does what we call it crystallizes. Okay, what we call it the fixed charge, the floating charge crystallizes to a fixed charge. Okay, and now the company, okay, can dispose of those inventory. Okay, the bank, okay, can dispose of those inventory to acquire or to get back or to repay themselves. Okay, for any overdue. Okay. So if that's the case, therefore, then you may or it may have an impact on the company going concern. Okay. One of the topics I'll discuss it a lot. Okay, will be on the going concern review. Okay, so this is one of the things that you may want to check. Okay, to assess whether the client is a going concern. Okay, could the company be in some loan agreement? Okay, has the terms and conditions been fulfilled? Okay, because if, for example, you have no inventory. Okay, then therefore your operation has been has been that. So it means you can operate more or less. Okay, it means you are in operational. Okay. Now, if the company, okay, if the company has made in a sale on the inventory, okay. If, for example, let's take the context of assuming this Toyota Kenya, okay, they sell motor vehicles. Of course, they give warranty, okay, that in case these vehicles breaks down in the next maybe 1,000 kilometers, okay, then we are going to either repair it for you for free, okay, or they're going to maybe replace it, okay, whatever the case can be, okay. So the company has, okay, what called a warranty, okay. They have given a warranty for the inventory they do sell. If there are warranties, then the company to be quantifying them, assessing what is the potential maybe damages, okay, that we can pay in the future, okay. They need to be accounted for, and all the chance that will happen, okay, because it becomes part and parcel of the company obligation. It becomes part and parcel of the company liabilities. Okay, the potential amount the company might be paying from damages, okay, that shall occur on the inventory they have made a sale on. Okay, assume the damages occur within the warranty period. Okay, so that's on the rights and obligations. Okay, question. Okay, so if there's no question, okay, where is David? Is not in class. Okay, so Quinta, so you should take a break.
Yes.
Okay, we meet at what time? Right now is 9:15.
9:30.
9:30, 15 minutes. Okay, fair enough. Then I take a break, then we come back at 9:30. Okay, so 9:30 then we meet then. Okay, so welcome back for our second session. And we are discussing on the last thing we were discussing was on the rights and obligations, was on the rights and obligation. Okay, so now we discuss on valuation and allocation. We discuss on valuation and allocation. Okay. As mentioned, the valuation, don't forget we are going to be referring back to the requirement of IS2 Okay, again, referring back to the requirement of the IS2. Okay, we're meant to value the inventory, the law of cost, and the NRV. Okay. Now, one of the procedures you can carry out as an auditor when it comes to testing as whether the company has done the allocation in the appropriate manner. Okay, you can obtain a copy of the inventory listing and agree the totals to the GL. Okay. So inventory listing, essentially, if you remember, we say that at the beginning, once as an auditor, you do get the test count, okay, that you're going to be agree the test count, okay, with the inventory listing, okay. So you agree the test count with the inventory listing. So more or less like the inventory listing, okay, is what the company, okay, has recorded in whatever system they're using, okay, as part of the inventory, okay. Now, once the inventory listing values, okay, once we have the inventory listing, okay, if the company say that we do have X units of this particular product, we have X units of this particular inventory, then that need to appear, okay. Let me just share, okay, my board here just to explain that bit of it. Okay, so the inventory listing of the company, for example, you can have the following: product X, product Y, product Z. Okay, for X they are 10, for Y 15. Okay, for Z they need to maybe as a 20. Okay, this is their value. Okay, so the value per unit. Okay, this is 5, this is 7. Okay, there's 8, and this is 10. Okay, therefore the total value is going to be 50. This is going to be 15 times 8 to give us 120. I guess 120. Then this is 200. The total value, okay, ought to be equal to 50, 170, 3070. Therefore, this 3070, okay, need to appear in the GL, okay. So you, as a company, prepare the GL, okay, upon which you're going to be extracting the values for the balance sheet, okay. Then this is what need to be appeared in the 3070. So ensure you're trying to reconcile these two values, okay. This 3070 need to appear, need to be the one that appears on the general ledger, upon which you're going to be extracting the account, the closing balances that appears on the balance sheet, okay. You need the two need to tally more or less, okay. As an audit, therefore, this is what you need to confirm that the two figures they do tally, okay. Cast the inventory listing to ensure it is mathematically correct, okay. So by casting, you see, we're trying to add them together, okay. So just like you just done here. Actually, the term casting, okay, casting is simply adding things, okay. So that by casting is simply adding. Okay, so in case you do find the term casting in future, okay, simply mean that you're trying to add, okay. So in short, we're being told add this 50, this 120, and this 200, okay, for us to get 370, okay, to confirm as to whether the addition, okay, or there's no and the mathematical error that occurred, okay. So do it yourself, okay. So therefore, add these figures together, okay. So cast the inventory listing, okay, to assess as to whether there's any mathematical error that may have occurred. Okay, so this is a recalculation, okay, more or less. This is a recalculation. Okay, so casting the different products that appears on the inventory listing, okay, to confirm the mathematical accuracy of the figures. Okay, so do a recalculation in short. Okay. So cast the inventory listing to ensure it is mathematically correct. Okay. Then vouch a sample of inventory items to suppliers' invoices to ensure it is correctly valued. Okay, so you can take a sample of the inventory item, okay, to supply invoices to ensure it is correctly valued. In short, if, for example, we just go back to the inventory listing. So here we do have product X, okay, so we have 10 units of X at this particular value, okay. So in short, therefore, you can vouch, take a sample of product X. And so that product X, we do have product X we made purchase from supplier A. Just an example, supplier A who supplied us with, look, these are units, and this is the price per unit, okay. So we bought 3 items from supplier A. From supplier B, we bought, this is 7 items, okay, to give us the 10 items, okay. This 10 is the 10 we have here, okay. So you can take, for example, okay, from supplier B, okay, you can decide the invoice from supplier B, okay. the value per unit is equal to 5. Okay, and the items from supplier B. Okay, you take the invoice. Okay, confirm as to whether the costing, okay, or the purchase value, okay, is as what appears on the invoice we got from supplier B. Okay, so vouch. Vouching means you take a sample, some sample of the inventory, okay, and you compare that with what the supplier, the invoice from the supplier was stating. Okay, so you should want to confirm. Okay, is it true that the total value, okay, the cost, for example, okay, was $5, going back to the invoice the company received from the supplier. Okay, hope that's clear. Okay, so you can vouch. Okay, take a sample. Okay, take a sample, vouch a sample of inventory items to supplier invoices. Now, where the company is using standard costing is used, okay, test a sample, okay, of inventory to ensure it is correctly valued. Okay, so in case the company is using the standard costing method, okay, so you can simply take a sample of it, okay, of inventory to ensure it is correctly valued. Okay. For materials, okay, I hope you still remember under your costing, okay, the standard costing method. I'm assuming that you still remember how you do carry out the standard costing method. The labor, any cost you incurred. In short, you want to assess all the costs incurred when it comes to the production of that particular item, okay? And of course, you can add the gross profit margin at the end of the day once you have obtained the total cost, okay? For materials, okay, agree the valuation of raw materials to the invoice and the price listing, okay? So in case the company we are using, okay, maybe let me just go back to our board here, okay? If, for example, the company is involved in a manufacturing setup, okay, of course, again, having the raw materials, okay, X, this the insurance or in dollars, labor cost, okay, direct and indirect, what it is, they'll give the total cost of production, okay, then of course you can have the gross profit margin, okay, and of course it's going to be the inventory value. So they may charge, okay, they have the inventory value, okay. When it comes to the raw material, okay, okay, so you can trace the raw material back to the suppliers, okay, so you can trace the cost of the raw material cost, okay, back to the supplier invoices, which I just mentioned that, okay, you can trace it back to supplier invoices, okay. When it comes to the labor, okay, you can ask the client to provide you with the wage records, okay, or the payroll records, okay. They can also provide you with the payroll records, okay. That's one way you can try to you can try to assess as whether the company has carried out has done a good work when it comes to costing for their product, okay. To confirm on the value of the raw material, okay, you can confirm that from the raw material suppliers by asking for the invoices, okay. On the labor cost, okay, you can ask the client to provide you with all the wage records they have used, okay, or the payroll records for the employees, okay, who are involved in the process of manufacturing that particular product, okay. Okay, for material, okay, so agree the valuation material to invoices and the price listing, okay. Confirm the client is using the appropriate basis for valuation, okay, so definitely, okay, that we need to confirm as well the client is using the correct valuation basis. Now we have, okay, there are 4 valuation bases you can use. Let me just confirm as to whether you still remember them. Petronila, hey, Petronila, we can't hear you. Hey, Petronila came to class and ran away. Jeffrey.
Yes.
Yes, so there are 4 valuation bases you can use.
Yes.
Okay, so name some of them.
FIFO.
Okay, so you have the first in and first out.
LIFO.
You have the last in, first out.
Weighted average.
We have the weighted average. And the last one?
I can't remember the last one.
Okay, and the last one is called the specific identification. The other one is called is the specific identification. Okay, so those are the four methods you can use when it comes to the evaluation of the inventory. In short, therefore, what we're trying to do here, okay, is as an auditor, okay, we are trying to assess whether the client has used the correct valuation basis. Okay, the client has used the correct valuation basis. Okay, now as per the IFRS, okay, because in the current context of Kenya, using IFRS, okay, there's a valuation basis you should not use. David.
Yes.
Yes, there's a basis, there's a valuation basis that you should not use. Which one?
I think LIFO, though I'm not sure.
Yeah, it's LIFO. And don't forget, as per IFRS, you should not use LIFO when it comes to the inventory valuation. Okay, we ought not use the LIFO when it comes to the inventory valuation. So don't use LIFO. And therefore, if your client is using LIFO, then of course, you need to advise them, okay, not to use that method. Okay, it is not supposed to be used in short. Okay, so the client should not be using, therefore, the LIFO, the last in, first out. Okay, so they can use their method, the first in, first out, weighted average, as well as the specific identification. Okay. If, for example, the client is using, okay, or in case the client is producing unique items, so they are not like mass production, it's not mass production. Okay. What method should the client use? Let me repeat. If the client is not mass producing, okay, if the client is not making bread, okay, if the client is maybe which one? Okay, they're making diamonds, or they're making, what are they making? Diamond rings, or they're making even maybe cars, okay, and they are not more or less the main items. What method should they be using therefore? Or in case the value per item is quite high, what method should the client use when it comes to the valuation of those inventory? Let me just confirm. Karen.
We can
Karen?
use FIFO.
They should use FIFO. Are you sure, Karen?
I'm not sure.
You're not sure. Okay. Emma. Emma?
Yes.
Yes.
Is it specific identification?
Yes, the specific identification. In that context, the client should be using specific identification. Okay, they should be using specific identification. Ensure, therefore, as an auditor, confirm as to whether the inventory valuation basis the client is using is the appropriate valuation basis. Okay, that's what that particular point is trying to tell us. Okay, so ensure the client has used the appropriate basis when it comes to the inventory valuation. Okay. Okay, for labor, I think I discussed already. Okay, for labor costs, definitely you need to, as a client, provide you with the documents. Okay, they use when it comes to paying wages to the employee, when it comes to paying the payroll records. Okay, so as a client, provide you with all the payroll records they do have with regard to the costing. Okay, don't forget to say that if, for example, the company is using the standard costing method, okay, don't forget they need to show how they obtain. Okay, just to go back. Okay, the labor cost, okay, and this way I mentioned, I say labor cost, okay. So as a client provide you with all the documentation relevant to the cost incurred towards labor when manufacturing that particular product, okay. Okay, so review standard labor cost in light of the actual cost and production, okay. So simply reviewing the labor cost incurred in light of the actual production that was incurred, okay. Reconcile labor hours to the time summary. Okay, so you can make a reconciliation. Okay, as per the timesheets. Okay, so the company will be having, okay, So you can make that a simple reconciliation towards the labor cost. Okay, so this company, of course, is going to have the labor cost they incurred along the way. Okay, so you can make a comparison with the timesheet. Okay, the timesheet, of course, is going to more or less every time an employee is maybe working for this particular product, okay, then of course they need to record the number of hours they worked, okay, so of course the time, of course, is can be how many hours were involved, okay, in making that particular product, okay. For example, there were 200 hours. This is just an example, okay, 200 hours, okay. Then what was the cost per hour, okay? So you can make that reconciliation, okay. If the cost per hour is maybe, for example, is 1,000, that imply therefore the total labor cost, okay, that need to appear in the standard cost here, okay, our standard cost card, therefore ought to be equal to 200 hours times 1,000 to give us 200,000. So if this figure does not reconcile with the figure we have here, then there could be a problem, okay? There could be a problem. That's what as an auditor, you may want to make that reconciliation, okay, of the hour spent and the cost incurred. The hour spent was the total cost incurred. The two need to more or less reconcile, okay. Reconcile labor hours, okay, they can mention that already, and the time summaries. Make inquiry to the management to ascertain any slow-moving stock, like mentioned, okay, as a manager to provide you, okay, how do you identify, okay, whether you have a slow-moving stock, okay, how do the manager identify a slow-moving stock, okay, so ask them to do that for you, okay, to provide you with their criteria, okay, of identifying the stock that you might be deemed to be slow-moving stock, okay, so the manager should also provide you with that. Okay. If we do have, or in case they are slow-moving stock, then of course the client needs to provide you with those recommendations. Okay, and the inventory, okay, they need to be, their value, okay, essentially need to be reduced. Okay, when it comes to the inventory evaluation, then of course there's no way the client can value those inventory the same way they do value the, okay, in quote, the normal stock. Okay. In case they are slow moving, then of course they need to be devalued, okay, because the potential amount the company can fetch from their disposal is a bit low, okay. So examine price at which the finished goods have been sold after the EID to ascertain as whether any finished goods need to be written down, okay. Events after the reporting period, okay, which I think you have already discussed, the event after the reporting period, okay. Let me just take here. Okay, what we refer to as the event after the reporting periods only. Okay. Now, what ISA do we use when it comes to checking on the events after the reporting period? Let me check here. Kami. Kami?
Yeah.
Yes, what ISA do we refer to when it comes to assessment of the events after reporting period?
32.
That's two. So not an IS. IS, that's two.
You're talking about ISA,
IS, sorry.
After 40, I'm not sure about that. I'm sorry.
Okay, no problem. Petronila, is your audio okay? I'm not sure. Petronila. Petronila. No, your audio is still okay. Emma. Hey, Emma.
Yes, I'm here.
Yes. Okay. So what IS do we use in this case?
I think it's IS 10.
IS 10, yes, it's IS 10, okay? Don't get to use IS 10, okay? The events after the reporting period, IS 10, okay? So that keys therefore, in case we do have what call the events of the reporting period, okay? If, for example, one of the, when it comes to the inventory evaluation, we see that you're going to value them at the law of cost and NRV, okay? Now, if, for example, we are closing the year on that 1st of December, okay, we close the year that 1st of December 2019, okay, and we valued, okay, we say that when it comes to the inventory valuation, it's the law of cost, okay, so cost and NRV. Assume that the cost was, let's say, $100, and the NRV was, let's say, 95. Of course, therefore, the closing value as a year, we did value the inventory at 95, which is because it's lower, okay. Now, if, for example, the same inventory, don't forget this is at that 1st of December. If maybe on the 10th of January, okay, the company made 2020, the company has made a sale of that inventory, okay, and the company was able to fetch, okay, the selling price then was, let's say, 87, okay, that implies, therefore, the company, they need to make adjustment to their balance sheet. Why? Because that inventory, as at December, okay, they were assuming they can be able to get 95. The reality, which happened on the 10th of January, they were able to get 87. Don't forget, the company should go ahead and make adjustment to their books, okay? They need to reduce that value to 97. They need to write down, so therefore they need to be an inventory, write down, okay, from 95 to 87. So as an audit, therefore, for the main to check as to whether is there any sale, is there any subsequent sale that may have occurred after the closing, the date of the year end, okay? Could it indicate that maybe we need to write down the inventory, okay? So all these you need to ask the client to give the information, okay? As to whether there is any potential sale that may have occurred after the year end that might indicate that we need to write down the inventory, okay? This is what that point said tells. Okay. If the standard level of finished goods remain unsold for an unusual prolonged period of time, okay, discuss the management and consider whether they need to be any write down that occurs on them also. Okay, so it's more or less like this point. Okay, so this point and more or less this is the point. Okay, making inquiry as to the management as to whether in case there's the inventory, okay, seem to be taking longer than usual. Okay. Should there be any write down that may need to be adjusted for on the closing balances? Okay, clear? I hope it's very clear to all of you. Okay, so next we're going to compare the gross profit, okay, to the previous year. I think you've already done this. Okay, so we're going to compare gross profit margin with the previous years. Okay, to check as to whether there could be any potential misstatement that might be occurring. Okay. Then compare material, finished goods, and the total inventory turnover to the previous year. Okay, so simply this is the use of the substantive analytical procedures, the use of comparison. Okay, analytical procedures, the use of substantive analytical procedures. Okay, so compare material, finished good value as the total inventory turnover to the previous year. Okay, in case there is a huge increase in the raw material for this year, okay, then you may want to ask the client, you may need to be justified, okay, as to why the company seems to be keeping excessive stock, excessive quote, okay, compared to last year, okay. Maybe the company is keeping more stock this year because there's going to be short supply of raw material in future, okay, more or less, okay. You can compare inventory days to the previous year and the industry average. Why do you want to compare inventory days? Okay, and don't forget, inventory days indicate how long you take as a company from the time you do, for example, purchase that inventory to the time you make a sale. Okay, so that time difference. Okay, now if last year the days were 30, if last year the days were 30, this year they are 60, should you be concerned as an auditor? Let me repeat. If the inventory days last year were 30, this year they are 60, should you be concerned as an auditor? Let me get your feedback. David.
Yes.
Should you be concerned as an auditor?
I should be concerned.
Why?
Can you repeat the question kindly? I get the point again.
So if, for example, the inventory days for last year, they were 30. This year, they are 60.
Yeah, you should be concerned.
Okay, why should we be concerned?
I think it may be due to It may mean that some of the inventory may not be accounted for. Maybe it's being given out with, like they are being given out for a longer period of time, so they may be misappropriated.
Okay, it could be that maybe the company is giving excessive days to their customer. Yeah, it could be one of the reason. Okay, for sure. Okay, but another huge concern. Okay, I agree, David, for what you said, but there's another concern here. Jeffrey. Jeffrey.
Yes.
Yes, should be concerned as a monitor if the days are increasing drastically.
Yes,
Why?
because the rate of turnover will be a bit lower.
So okay, I agree, the turnover is low, but why would you be concerned? It's okay for it to be low, but where is the main concern as an auditor towards how the company is accounting for it?
There may be a chance that the sum of the inventory will not be accounted for properly.
Okay, the possibility. Okay, see the possibility. Okay, thank you, Jeffrey. Samuel.
Yes.
Yes.
Inventory days.
Yes.
Yeah, I think you should be concerned.
Okay, why would you be concerned?
Because the do you mind explaining what the inventory days are?
Inventory days. It simply mean how long do you take, okay, to by the time you bought the good and the time you make a sale, what that time difference? That's what we call the inventory days. You bought the good on 1st of March. When you make the sale of that good, it was on 20th of March. So what's the time difference? 10 days. You get it?
Yeah, I get it.
Okay. If the days are increasing, as an auditor, okay, why would you be concerned if the days are increasing?
Maybe there are some sales which are not being recorded, or there is.
So maybe there could be sales that are not being recorded.
Yeah.
Okay, still could be a reason. Okay, Quinta.
Yes.
Yes.
It could be that there are some goods that are becoming obsolete.
The goods are becoming obsolete.
Maybe.
Yeah, that's the most likely scenario. That the goods the company may be selling. The question is that why are you taking longer to make the sale? Why are you taking longer to make the sale? It could be that the goods you're having are becoming obsolete. I mean, the market does not want you what you're selling, maybe. Okay, all that will be the most likely scenario. Which means, therefore, when it comes to the valuation, then the company needs to recognize a lower value for the inventory. Okay, compared, for example, to last year. Okay, because if you're taking longer, why are you taking longer to make the sale? Okay, most likely it could mean, okay, that the company inventory are becoming obsolete. Therefore, when it comes to the valuation of the inventory, we need to have a lower value, for example, compared to, for example, what we had last year. Okay, that's the essence of trying to do the comparison of the inventory days. Okay, comparing the inventory days. We're going to compare the starting cost for this year with the previous year, with the current year. Okay, that's another way of comparing cost of last year was cost for this year. If this cost is increasing, of course, we need to assess why is the cost increasing. Could there be a justification as to why the cost is high? Okay. Compare the overhead for maybe the last year or even for this year, okay, with the budgeted versus, okay, the overhead, the started cost for this particular product, for example, okay, comparing the budgeted versus the started cost, okay. So in case the costs are much more higher than what was budgeted for, okay, do you have a future for this particular product, for example, okay. So all these are some procedures that you can carry out with regard to valuation and the allocation. Okay. Question? Okay, so in case there's no question, then I guess we can call it a day. Okay, and we meet tomorrow. Okay, then see you tomorrow. Then we shall start with cutoff tomorrow. Okay, see you then. Remember to sign the register.